Three things happened in the past few days that should make every AI investor nervous. Michael Burry just took out $900 million in puts against Palantir. Deutsche Bank is exploring hedges against their AI data center loans. And OpenAI, yeah, the company supposedly printing money, is now asking the government for loan guarantees. Look, if you're short on time or if you just stumbled on this channel and don't trust some random guy on the internet, here's what you need to know. These three events are not random. They all point to the same underlying problem. The financial plumbing backing the AI build-out is starting to show stress. Not collapse, not yet anyway, but stress. And when trillion-dollar flows meet uncertain returns, things get, well, rather interesting in ways your portfolio might not like. Alright, so hey, I'm DataCat, and yeah, before you ask, that's actually what I go by. I used to be a corporate analyst, you know, the kind that keeps staring at messy data while pretending it makes sense until your eyes bleed. I traded that soul-crushing routine for, well, this. Making videos with my cat occasionally walking across my keyboard. This channel's only about 3 months old, so if you're new here, welcome. I'm not some guru, I don't have a Lambo, and honestly I'm pretty introverted, so I'm not gonna sit here and brag about finding the next 10x stock. What I will do is break down what's actually happening in markets, using the same analytical framework I used in my corporate days. And you know, smashing that like and subscribe button would certainly keep me motivated. It's definitely much more useful than being gaslighted by my former manager. And yeah, I make cat jokes, because if you're going to talk about financial markets potentially imploding, you might as well have some fun with it. Plus, cats are great. They're cute, they're fluffy, and they'll knock your coffee off the table while maintaining perfect eye contact. Kind of like the Federal Reserve, actually. Now, today's video is a bit different from what I usually do. Normally I walk through macro trends, maybe look at some stocks, throw in a chart or two showing support and resistance levels. But today is more of a discussion or an alert, because something is shifting beneath the surface of the AI trade. And it's the kind of shift that doesn't show up in a price chart until it's too late. So let me walk you through what happened, why it matters, and more importantly, what you should be watching right now. Let me start with the facts, because facts don't care about your portfolio allocation. First, signal number 1, Michael Burry's puts on Nvidia and Palantir. If you follow markets, you know who Burry is. He's the guy from The Big Short, the guy who saw the housing crisis coming when everyone else was partying like it was 2005. His latest 13F filing just dropped, and buried in there were puts, lots of them. Specifically, $912 million notional on Palantir and $187 million on Nvidia. Now, before you panic sell your shares, let me add some context here, and this is important, no matter whether you agree with Burry or not. Burry has been shorting the market multiple times over the past few years. He also bet big on Chinese stock recovery. And while he might eventually be right, timing and size matter. You can be right about direction and still lose money if your timing is off, or if you're over-leveraged. Also, 13Fs don't tell you the strikes, the expiration dates, or whether these puts are outright bets or just part of some hedge. Could be a spread, could be protection on a long position, we don't know. What we do know is this. A very public, very smart investor is positioning for downside in two of the most hyped names in AI. And the next day, Palantir's CEO Alex Karp literally came out swinging, pushing back publicly. That tells you how contentious this moment is. When CEOs feel the need to respond to a 13F filing, it means nerves are frayed. Then we have signal number 2, Deutsche Bank exploring hedges against AI data center lending. This one flew under the radar for most retail investors, but it's arguably more important. Deutsche Bank has been lending heavily into AI data center build-outs, and now they're reportedly exploring ways to hedge that exposure. 2 methods specifically, shorting a basket of AI stocks or using something called synthetic risk transfer, which is basically a way to offload credit risk to other investors who want it. Now, is Deutsche Bank calling a top? No, probably not. This is just prudent risk management. When you're a bank sitting on billions in loans to a brand new sector with unproven cash flows, you hedge. That's literally banking 101. But here's the thing. The fact that they're doing it publicly, the fact that they feel the need to engineer downside protection right now, tells you the financing stack is under pressure. They're stress testing scenarios where things don't go as planned. And finally, signal number 3. OpenAI seeking government-backed loan guarantees. This is the wildest one to me. OpenAI, the company everyone assumes is printing cash, is now in talks to secure government-backed loan guarantees. Why would they need that? because building AI infrastructure is insanely expensive and the math is getting harder to justify without cheaper, longer-dated capital. Think about it. GPUs depreciate fast. Every 2 to 4 years, you're looking at new hardware cycles. But debt tenors, the length of the loans, are 7 to 15 plus years. So you're borrowing long to fund short-lived assets with uncertain payback periods. That's a duration mismatch, and it's a problem. Government loan guarantees like the ones we saw for electric vehicles or renewable energy projects can help by lowering the cost of capital. But the fact that OpenAI, a big tech, needs this kind of public sector backstop is unusual. It tells you the private market alone isn't confident enough to fund this at scale without help. Okay, so you might be thinking, DataCat, these are three totally different things. A hedge fund guy buying puts, a bank hedging loans, a tech company asking for government support. What's the connection? So, here's the connection, or at least what I think. All three of these signals are different views of the same underlying stress. Financing risk for an unprecedented capital-intensive AI build-out. Allow me to break it down. From the equity side, that's Burry's puts. The signal is, are the returns really there yet? Is the market pricing in perfection, and what happens if reality disappoints? Nvidia and Palantir are trading at valuations that assume flawless execution, endless demand growth, and zero hiccups in AI adoption. Any disappointment, any shift in AI economics, and those multiples compress fast. From the lending side, that's Deutsche Bank. The signal is, these loans are big, the sector is new, and we need to cushion tail risk. Banks don't hedge because everything is fine. They hedge because they see scenarios where things aren't fine, and they want to make sure they're protected. From the operator side, that's OpenAI. The signal is, we need cheaper, longer-dated capital, and the private market isn't giving it to us easily. We need the government to step in. That's not what you'd expect from a sector everyone claims is a sure thing. So you have equity saying prove it, lending saying protect me, and operators saying help me afford this. That triangulation tells you we're in a messy, uncertain phase, maybe late early cycle, maybe mid-cycle, where the financial plumbing is being redesigned in real time to carry trillion-dollar flows, but near-term ROI is still a giant question mark. Alright, so the natural question remains, is this a bubble about to pop, or is this just healthy growing pains in a real build-out? Let me give you both cases, because honestly, the answer depends on what happens next. Let's talk about the bubble case first. 1. Circular financing. Remember the Oracle, OpenAI, and Nvidia investment earlier? This is when the same set of players, chip vendors, cloud providers, data center operators, keep recycling capital among themselves through strategic investments, vendor financing, and offtake agreements. It creates entanglements that amplify shocks. If one link breaks, the whole chain rattles. Michael Burry actually amplified coverage of this circular deals concern, and it's not paranoia, it's a real fragility risk. 2. Duration mismatch. I mentioned this earlier. GPU and equipment cycles are 2 to 4 years. Debt tenors are 7 to 15 plus years. If model efficiency improves faster than expected, or if demand elasticity slows compute growth, your payback windows get longer, your debt service gets harder, and suddenly projects that are penciled in at 8% returns are underwater. 3. Power constraints. Data centers need massive amounts of electricity. Grid interconnections take years. Power purchase agreements are getting expensive. Capacity is scarce. If power costs spike or availability tightens, project economics shift abruptly. And unlike software, you can't just pivot a data center. Then we got the healthy correction case, where risk is being managed. 1. Banks hedging and using synthetic risk transfer is actually what you want to see in a prudent build-out. It moves risk from banks, who aren't great at holding it long-term, to capital markets and investors who want that exposure. That keeps lending flowing without banks getting overexposed. 2. Government guarantees can de-risk systemically important capex, the same way Department of Energy loans did for electric vehicles and energy projects. It supports a secular build without requiring equity multiples to stay at insane levels. It's a maturity step, not a panic move. 3. Visibility on AI monetization is improving. Enterprise deployments are maturing. You're seeing multi-year contracts, usage floors, better unit economics. That bridges the gap between capex now and revenues later. If that trend continues, the math starts to work. And what's my read? Conditions are tightening around financing and risk transfer, but they're not collapsing. I think we might be seeing episodic sharp pullbacks as the market reprices growth expectations, maybe 10, 15, 20% drawdowns in individual names. But structurally, this looks more like the financing model evolving toward more diversified risk-bearing. Banks, private credit, public backstops all sharing the load. That's not the end of the build-out. It's the build-out getting serious, unless we see multiple tripwires fire at once. Which brings me to what you should actually be tracking. Alright, so if you're still with me, and if you are, seriously thank you. I know this is dense, let me give you the practical stuff. The high-impact data points you should be tracking if you're invested in AI or adjacent sectors. First, the most straightforward one. Hyperscaler CapEx guidance. Microsoft, Amazon, Google, Meta. These are the ultimate demand drivers for AI infrastructure. Every quarter, watch their CapEx guides. If they start flattening or cutting while GPU and server suppliers are still guiding up, that's a divergence. That suggests inventory risk, demand weakness, something's off. 2. TSMC monthly revenue and lead times. Taiwan Semiconductor makes the chips. If their revenue mix shifts, if lead times collapse, if advanced packaging capacity sits idle, that's a demand signal before it even shows up in Nvidia's earnings. 3. Data center REIT leasing and pricing. Companies like Equinix and Digital Realty are landlords for data centers. Watch their net absorption, basically how much space is getting leased, and watch pricing. If leasing slows, if discounts widen, especially in power-constrained markets, that's a leading indicator that demand is softening. 4. Data center credit spreads and securitization issuance. If new data center asset-backed securities stall, or if spreads, basically the risk premium investors demand, start gapping wider, that tells you credit markets are getting nervous. That's real money voting with their feet. 5. OpenAI and the government guarantee progress. If we actually see a concrete term sheet, an agency designation, a program launching for AI infrastructure loan guarantees, that's a huge de-risking signal for the whole funding stack. It lowers the cost of capital system-wide. Track news on this. It's developing. 6. 10-year treasury yields and investment-grade credit spreads for tech issuers. This is your macro overlay. Rising yields and widening spreads directly pressure financing costs. If the 10-year runs back up to 5% and tech spreads blow out, funding gets harder fast. The tripwires I'd set alerts on. Hyperscaler CapEx guides flatten while suppliers guide up, inventory risk. REIT net absorption slows or pricing discounts widen, demand risk. Data center credit spreads gap wider or issuance stalls, funding risk. And on the flip side, a material policy step toward loan guarantees, de-risking signal. So, bottom line. The three signals we opened with, Burry's puts, Deutsche Bank's hedges, OpenAI's loan guarantee hunt, they're not random. They're interconnected facets of the same problem, matching short-cycle, high-uncertainty tech equipment with long-cycle, massive capital and power requirements. The system is already adapting. Banks are transferring risk, operators are seeking public backstops, equity is challenging stretched expectations. That dynamic leans more toward an ongoing choppy repricing and a more institutionalized funding model than a definitive bubble burst. But, and I can't stress this enough, you need to stay sharp. Watch the data points I just laid out. If multiple tripwires fire at once, the repricing accelerates, and it won't be pretty. I'm not saying sell everything and hide in cash. I'm saying understand the financing stress beneath the hype, position accordingly, and don't assume trillion-dollar flows run on vibes alone. Alright, that's it for today. If this was helpful, hit the like button, subscribe if you want more of this kind of breakdown, and drop a comment if you think I'm wrong, right, or just completely off my rocker. I actually read those. And as always, stay curious, stay skeptical, and for the love of all that is holy, don't bet the house on narratives. Bet on data. I'm DataCat, thanks for watching. I'll see you in the next one.